in the insurance and investment and financial industry, there are standalone products, but then there are also hybrid products. Welcome to the Impact School of Money, where our mission is to change the way people are educated on money. I'm Adam Davis. I'm your host, and this is episode 4. So diving into our product of the day of how it works, what we're going to talk about is hybrid products. So diving into how it works, how different products work, and the best way to describe this is to start with a story. So how many of you remember, or you probably know somebody that still is in this situation, the Franklin Day Planner? You know, the Franklin Day Planner with the hole punch, and you put in all the filler pages, and you can plan out your week, and you can plan out your life, and there's little quotes in it, and all those things. And so back several decades ago, really, is where they became the most popular. And then as time went on, the Palm Pilot came around, and other devices that were calendaring or scheduling type devices that people would use. Then people also needed to take pictures. And so they would have, you know, the camera with film and then the digital camera, etc. But they kind of had those two things as separate things. They had their camera, they had their planner, and then with the invention of the cell phone is people started carrying around a phone as well. So you can imagine, you know, with a big planner, a camera, and wanting to carry around a phone, especially when that first phone came out, you know, with the antenna. I mean, it was it was like this big. It was just this massive brick phone, right, with that huge stiff antenna. And so you'd have to carry around this big bag just to have everything. And that worked for people. Where today, you look at a planner, a camera, and a phone, what is it that people use today? They use one of these, right? They have a smart device of some sort that triples as all three, where a cell phone, the smartphone today, could be considered a hybrid product. Now, there are people that still carry around all three, but the cost is a little bit higher. They got to fill the pages. They got to, you know, to maybe develop the film. They've got to constantly be getting a new phone, and nowadays people will use hybrid products. And so in the industry, in the insurance and investment and financial industry, there are standalone products, but then there are also hybrid products. We can have a life insurance policy here. We can have, to address our death needs, I guess you could say, if something were to happen. And then what we talked about today, people can have a long-term care plan, a standalone long-term care policy for those needs. And then they can also have savings plans to fill those needs. If people need money to, you know, buy a car or have emergencies or whatever, and then there's ways to have those things all together in what we're going to talk about today, the hybrid type plan. And so there's quite a few hybrid plans, and we're going to talk about 3 specifically today. And so the first is one that some people don't look at as necessarily a hybrid plan, but it takes care of 2 of those 3, life insurance, long-term care, and savings, where it takes care of at least 2 of them in a very less expensive way than getting a permanent insurance plan. And this is maybe one that you've heard of or maybe not. So the first one that we're going to talk about is called ROP, or return of premium. So what a return of premium is most of the time, the majority of the time, is a term product that we pay for a certain term of time, and we pay our monthly premium, our monthly premium, our monthly premium. If we die, we get a death benefit. If we live during the term, it doesn't have cash value of any kind, but if we get to the end of the term, say this is a 20-year term, and I get to the end of that term, and I haven't died, if this is a traditional term policy, my options are convert or just let it finish. Let it just, I had it for 20 years, it was a 20-year term, and that's what I got it for, and now it's done. Or what a return of premium does is they would add up everything that was paid from here to here and refund that to the client. They keep it simple, or try to anyway, and they tell you what it is by the name of it. Return of premium. You get to the end, they're going to return your premium. There's others, hybrid versions of this, or just evolved, I guess evolved would be the better word, evolved versions of this, where if you get to here and you decide you don't want it anymore, then there's a portion of your premiums that then can be refunded. And so it's not necessarily savings, but it is something where you can get the money back, and that's a return of premium. So that's number one. Number two that we're going to talk about today, anyway, number two is going to be term with living benefits. Term with living benefits. And this one is actually a very unique product in the industry from research we've done and products that we've seen. There's only one company that has a built-in term with living benefit, which is a Transamerica Trendsetter LD is the name of it. LD meaning living benefit, where what it does is in a traditional term plan, we have our death benefit of, say, $250,000. That means if we die, we get $250,000. Where how a term with living benefit would work is instead of just this being a death benefit, it's just an insurance benefit. Just kind of an overall benefit. And so as we pay premiums into it, if we were to die, $250,000 goes to our beneficiaries. But if we were to have a heart attack or stroke or get cancer, or there's a whole list of things that trigger the use for this benefit for other reasons. So say the insured, the person that has a policy, has a heart attack. They have a heart attack, they can now access parts of this benefit to pay for medical expenses, living expenses. They submit a doctor's note that says that they've qualified for the triggers in this policy that then turn it into living benefits, not just death benefits. And so with both that we've talked about so far, the return of premium term and these policies, the premium is higher. You have to think about it sometimes from the life insurance company's point of view. If we're offering additional benefits on top of just the actuarial math that they have to do to figure out if you're going to die or not, they're also figuring out, okay, what are the chances now of them dying and potentially needing this additional benefit? And so they have to do those extra calculations. In this example right here, let's say I was to get this policy on me. $250,000 30-year term. Actually, let's do it this way because then we can look at all of them at the same time. So I'm going to keep using black because I think we can see black the best. Maybe blue would work. I'm going to try blue. Let me know if blue works. Maybe send me a text. That's usually the best way for me to see it because my phone's sitting right there and I don't want to reach over and clicking on the computer and stuff. So if you can see blue, maybe just let me know. So the first one is we just have traditional term. If we have a traditional term policy and the premium, let's say, is $20 a month for a $250,000 policy, if I was to get a term with living benefits, we would think it would be kind of significantly more. Surprisingly, the average increase is somewhere between $5 and $10 per month to add that benefit. I've seen it as low as 3, 4, 5, all the way up to about 10 additional dollars per month to add the living benefit, which just turns that insurance benefit into a total insurance benefit instead of just a death benefit. And if you've been around for a while and you're like, why does he just keep repeating the same thing over and over? It's really to reinforce what it is, clarify maybe the first time you heard it, and to just get it into our mind. Okay, so then the one before, return of premium term, surprisingly on this is pretty significantly more, actually. If I was to get a $250,000 term and it's $20 a month, return of premium might be somewhere in the range of $80 to $100. $80 to $100 a month. Why? Because if you think about it, if I pay $20 a month for a year, that's $240, and I do that for 10 years, I put $2,400 in. If I do that for 20 years, I put $4,800 in, and so on and so on. So the insurance company has to be making enough to cover the risk of the person through all the actuarial math. Is how, we've got to cover this person in case they were to pass away. But then we also have to think about sometime here in the future, if they live, we're going to have to give all this money back. And so they're basically splitting this into 2 different buckets. One bucket being the actual life insurance itself, and then the other bucket being some sort of interest-bearing account, not for you, but interest-bearing account for them, that they know that, okay, in 20 years, if he's still alive, the difference that's going into this bucket, has enough interest growing on it to make up for what they were paying in life insurance, so that at the end we can give them all their money back. And so that's how term, traditional term with living benefit, and return of premium are priced as far as a premium goes. Okay, and then next time, next episode on Tuesday of next week, we're going to talk more in depth about life insurance riders, different riders that can be added to life insurance plans. I was going to include it in this one, but realized there are so many different riders that we won't have time to cover it in this episode as well. But we'll be talking about the different riders that can be added on top of the long-term care rider that we'll talk about next. And so we'll just be focusing on one today, speaking of hybrid plans, and then we'll cover the rest next week. So that's how it works as far as premiums go. Okay, next, and lastly, what we'll look at is more specifically that inverse X curve and how that can be a benefit for people that have long-term care needs. And before we jump into this, I was reading a brochure put out by an insurance company that says over 70% is the chance, if you have a married couple, you have a husband and a wife, they have a 70% chance that one of them will need some sort of care, long-term care, in-home care, etc. That's a pretty high chance. And so I met with a gentleman last night who said in all of his retirement planning, I asked him if they had done any long-term care planning, and he said that it came up, but he didn't feel like it was necessary. Well, if you have a 70% chance of anything, it might be worth protecting yourself. If the chance is 70%, that's pretty high. It's pretty high. But this is a conversation that a lot of people don't have, because a standalone long-term care plan is expensive, and we'll cover that on another episode when we get into health products and disability products and long-term care and all that stuff, but we're talking hybrid products today. So a standalone long-term care plan can be $200, $300, $400, $500 a month, where if it's combined in a life insurance plan and added as a rider to a policy, it's actually the least expensive way to get long-term care. I had a client of mine that looked up on the Social Security administration's website, Long-Term Care, and it said that adding it as a rider to actually it might have been AARP. Was it AARP's website or Social Security? I don't remember, one of those two. And they were looking it up, and it said that the least expensive way to pay for long-term care needs is to add it to a life insurance plan, because they're just able to spread out the risk a little bit more, and that's what makes the price go down. And so how that would work is I have my total benefit, and let's say that somebody has a $500,000 life insurance with long-term care rider. Okay, what happens is they have kind of two elements. They have the benefit, and then they also have, usually with these plans, a cash accumulation element to it, a cash value, that as they put the premiums in, part of it is going to be filling up the bucket of money, and then part of it is going to pay for this benefit. I have, just to give you an example, a client that is paying for one of these plans, and the portion that goes to that long-term care rider is only about $30 a month that goes to that rider. So it kind of takes care of three things, kind of like the planner, the phone, the digital camera, is if they need access to cash, they can do that through with loans and withdrawals from the permanent insurance plan. If they die, it's a death benefit that goes to their family, and if they have if they have an increasing death benefit, then they get the life insurance money, the $500,000 plus the cash. So that now takes care of two. It's life insurance and it's cash. But then if they end up in a long-term care facility, they have long-term care coverage. So this product answers a lot of what ifs. Well, what if I don't end up in long-term care? Well, then you can use the cash and it's life insurance. Well, what if I go to long-term care for like 1 month and I've been paying for this long-term care plan this whole time and then I die? Well, then it's death. It's the death benefit. What if I go into long-term care for a month and it was a false alarm and I'm able to come out of the long-term care facility? Well, then it just goes back to what it was, and now it's life insurance, and you've got some cash to spend, right? But if you do go into a long-term care facility, how does that work? They take this, and you can take up to 2% per month to pay for long-term care, and because it requires a health insurance license if you add a long-term care rider to it, this income that comes off of this, and you don't have to take 2%, it's up to 2% is what you could take, comes out tax-free. So in this example, they would be able to pull out $10,000 per month, totally tax-free, to take care of long-term care needs. And does it take care of long-term care for the rest of their life? Not necessarily, but how long do most people end up being in a long-term care need situation? The average is somewhere between 2 and 4 years. 2 to 4 years, which is why most long-term care plans are set up to pay out for about that amount of time. But through this hybrid plan, or a life insurance with long-term care rider, takes care of all three. And so, from a financial consulting point of view, having tools in your bag that fulfill multiple needs can be a huge benefit to clients, especially if they're meeting with a company, with an individual that doesn't have these as options, and maybe these have been options all along that you just hadn't heard about, but then you can start applying. But it's just asking the questions as we meet with people of, of all the planning that you've done, have you done retirement planning? Have you done insurance planning? Have you done emergency fund planning? Have you done college planning? One that's a lot of the time gets left off is, number one, estate planning gets left off. And this can help with estate planning a lot. And then number two is, have they done any long-term care planning? So an agent just recently, one of our agents, and since we're still a small group getting on this, Kelly Warner, did a presentation on these hybrid plans to a group of professionals and got 9 referrals just from talking about this. And here's what you need to listen for. As you're out and about, as you're eating lunch, as you're at the family party, as you're at church, as you're out and about, whatever you're doing, is to be listening for people that say, hey, recently we had to move my mom into a home. Or, my dad fell and he broke his hip, and now we've got somebody coming in to take care of his long-term care needs. Or, the home that my grandma's in is being investigated for whatever. Or the home that my grandpa in is won some award. Or, they talk about their grandparent in a home, or their parent in a home, or moving them into a home, or needing to move them into a home. It is a trigger to talk about the need for long-term care, because these facilities are $3, $4, $5, $8, $10, $15,000 a month. And so when you look at that inverse X curve, your wealth has been growing this whole time. You want to retire on it, and then someone moves into a home, plus you've got the expenses of the spouse that's at home. Your wealth drains very fast. Where if you have a long-term care benefit, that wealth can now do more something like this and last longer, or if it's in the right type of investment plan, then it could do more of something like this, and they're just pulling the interest off because that long-term care plan was put in place so that it pays for those long-term care needs. So again, thank you for joining us on the Impact School of Money. This has been episode 4, where we covered hybrid plans and the inverse X curve. Next week, Tuesday morning at 7 o'clock, we'll be doing the same thing, episode 5, where we'll be covering a new 5-minute concept, and then we'll jump into 2 different types of life insurance as we continue on with Life Insurance Awareness Month, of life insurance riders, other riders that can be added to life insurance plans, child riders, disability riders, etc., and annual renewable term. So thank you again for joining us this morning. Have an awesome day.